So the banks are crashing, or at least likely to be crashing, and the U.S. Treasury, Federal Reserve, Biden administration are all working diligently, rapidly to try and mitigate this contagion, possible contagion, and systemic risk of total bank failure of this fragile ecosystem of a mental construct of fractional reserve banking and the lending and borrowing of fictitious money, ones and zeros that don't actually really exist. But without this unicorn, mysterious banking system practice, everything that we know would literally fall apart. But what about the credit unions? Arizona Central, AZ Central, failed bank fallout could open doors for credit unions. And what doors would they be opening? Are they opening doors for credit unions to pick up new accounts? Possibly, if you are eligible to become a member of these credit unions, because they typically require some sort of reasoning behind the memberships that they allow? Or could it potentially open up the door for credit unions to face contagion and systemic risk and possible failure, as our dollar, as the U.S. currency, as the world's reserve currency for that matter, and all forms of money, tools, various means of bartering and conducting business transactions are possibly looking to be replaced, eliminated, and we see central bank digital currency rolling out. Now, I do want to preface this with two important notes here. The first one being that, one, please avoid the scammers, the spammers, the bots, the trash, the frauds, the doppelgangers in the comment section down below. If you want to contact me, if you want to reach me, my information is in the description. I will never try to contact you in the comment section. I will never try to text you or chat with you on WhatsApp or any of that nonsense, okay? And then the second being that FedNow is rolling out in July, and we know that for a fact. FederalReserve.gov has shared that information. I've actually made a video about that not too long ago. While I am working on putting together even more information about it, information shared by the IMF as well, and what we are likely to expect after FedNow, that they're not quite making very clear, but has a lot to do with how the FedNow system is more than likely going to roll into the central bank digital currency, CBDC, while at the same time more than likely wiping out and killing cryptocurrency, killing decentralized crypto, killing tokens, altcoins, altogether. We're going to cover that. So if you want to see that video, or you want to be first to see that when it comes out, make sure you have your alerts turned on. Make sure you subscribe to the channel and turn on notifications, as well as please give this video a like, because it really helps out with the algorithm and getting this information to more people. Comment down below any questions, comments, and concerns. Now we're going to get right into this, because I have a lot to discuss with you about these credit unions and the possible risks that these credit unions may face. So we see here that the failure of Silicon Valley Bank and heightened concern over the fragility of the banking system could drive membership gains for credit unions, membership gains, which provide many of the same financial services, but with different motivations and with different repercussions when they fail. So I think the key here is understanding the possibility of credit unions failing. Now, folks, this is not me trying to create panic, fear, alarming you, fear-mongering, alarmist, all those negative words that people try to throw at me, for merely trying to share this information and help educate and help people prepare better In my opinion, it's really hard to prepare when you don't know what you're preparing for, and it's hard to prepare when you don't have the knowledge and education. That's what we're doing right now. We're gaining knowledge and we're gaining education. So, it says here, when they fail. Therefore, credit unions are not immune to failure, okay? What does a credit union do and how do they differ from banks? This is a pretty much reoccurring question being asked regularly on my channel, on my videos, and let's answer that question. Or at least let's let AZ Central answer that question, because the question is very broad. But we'll provide a very broad answer. However, when you ask the question of how do credit unions differ from banks, when you drill down on specific points and specific areas and specific topics, then, it gets a little bit different. But generally, credit unions are not-for-profit institutions that cater to customers or members who share a common bond, whether it's employment in a certain industry, military service, membership in the same religious domination or denomination, people living in the same state, or something else. They offer most of the same products and services as banks, from checking accounts and mutual funds to car loans, home mortgages, and business loans, and they frequently compete directly with banks. So, as I mentioned, having the ability to be eligible for membership in credit unions will depend on possibly different factors. And here they list industries, military service, religious denominations, location of where you live, and other things like that. I think that this plays a role in the success of the credit unions, but also possibly the major downfall and risk of these credit unions. But the success lies in the like-minded forward continuous progress that is being made by these collective groups. They all share a common goal in mind, typically. But one difference is that credit union profits are plowed back into their operations to help lower loan costs and boost deposit interest rates for the benefit of the members. Another difference is that credit union executive officers often are more reflective of mainstream America, and the people who sit on credit union boards are members too. So, let's think about this. I've actually experienced my credit union competing with my bank, and they always beat my bank's rates on any loan, any lending product, any financial tool. Credit union always wins. But it's because they're not trying to make a profit. They're just trying to support the memberships and grow their total assets and continue on with this progress and keep these credit union employees employed. But the difference is that credit union executive officers often are more reflective of mainstream America. And also we see here that credit unions' profits are plowed back into their operations to help lower loan costs and boost deposit interest rates. So we can see that the credit unions are utilizing their funds in a much better purpose than, for instance, Silicon Valley Bank. Now let's talk about the possible causes of credit union failures, as credit unions do fail from time to time as well, and have seen a few more failures in recent years than banks. Nationally, 2 have gone under already in 2023, and on average 7 failed in each of the prior 5 years, according to data compiled by the National Credit Union Administration, which is NCUA, a federal agency akin to the FDIC, or Federal Deposit Insurance Corporation, for banks. During and immediately following the Great Recession, credit union failures were more common than they are now, as were bank failures. And one Arizona institution that failed in 2010, AEA Federal Credit Union, was able to recover after working 5 years with federal regulators. And then the institution serves roughly 32,000 members in Yuma and La Paz counties. So, credit unions can fail. Credit unions have failed. Credit unions will fail. Credit unions also have deposit insurance for insured deposits similar to the FDIC through National Credit Union Administration, NCUA. But we're not done here, folks, because when credit unions go under, they don't pull down the stock market or trigger systemic worries because credit unions don't have shares trading in the market. Therefore, credit unions also typically are smaller than banks, though some of the larger ones count roughly 100,000 or more members and hold more than $1 billion in assets, primarily loans. Larger Arizona credit unions include Desert Financial, Arizona Financial, 1AZ, and True West. And oftentimes, credit unions sometimes rely on some of these larger banks to help fund some of their operations and lending. But one risk to which many credit unions are exposed is geographic concentration of their loans and members. Reflecting the state's strong economy, Arizona's credit unions right now are national leaders in many metrics, including asset growth, deposit growth, membership growth, return on assets, and profitability. And last year, Arizona's credit unions ranked number 1 in loan growth according to the NCUA. But this is very important because they are exposed in geographic concentration. We're going to touch on that in just a moment. But first, let's discuss these uninsured deposits being an issue at credit unions because credit unions offer essentially the same $250,000, $250,000 deposit insurance per account as banks, with the coverage backed by the full faith and credit of the United States government and support by a deposit insurance fund. But like banks, some credit unions also have uninsured deposits. At 1AZ, for example, 12% of its entire $2.97 billion in deposits was uninsured at the time of 2022, at the end of 2022. And some of that represents temporary circumstances such as members who recently sold a home, transferred the proceeds to their checking accounts, and haven't deployed the cash elsewhere. So think about it. For instance, let's just say you've got a home and it sells for $500,000, and you owed $200,000. Therefore, you would receive your gain, your capital gain from it of $300,000, and therefore that $300,000 would have to be put somewhere. Now, in consideration to what we're discussing here, why not put $150,000 in one bank and $150,000 in another bank? Diversity. However, let's just say you put all $300,000 into one bank, you're immediately now exceeding the limit of insured deposits, and you're now at risk because the NCUA does not cover deposits over $250,000. Therefore, some of that can represent these temporary circumstances, such as members who recently sold a home, transferring the proceeds to their checking accounts and have not yet deployed the cash elsewhere. Again, diversity, deploying the cash elsewhere, diversity, security, and cash flow. So the diversity, in my opinion, in this particular situation would be divvying up these funds so they're not, all my eggs aren't in one basket at risk. The security would be just doing that, as well as a variety of other measures. More than likely, I probably have some of that cash tucked away outside of the banks. And then the cash flow aspect is going to come in the form of deploying the cash elsewhere. And therefore, you can deploy the cash elsewhere. That also adds to your diversity. It also adds to your security. But that's the goal, folks, is to have this money not just sit in the banks, but have this money out in the world working to bring back more money. That's how passive income is built. Uninsured deposits at Silicon Valley Bank were reported as to be much higher on uninsured, in the neighborhood of 90%, precipitating a run by depositors that doomed the bank. Now, granted, the bank didn't run out of money, but they were on track to be dangerously low on deposits, and they didn't have the actual physical cash reserves to back it up. However, a small portion of banks and credit unions don't offer deposit insurance, so it's important to inquire about this safeguard and not just assume because your money is in a bank or in a credit union that it's safe and protected. Like banks, credit unions also have to make sure to spread their loans to mitigate risks. And as an example, high concentrations of loans backed by taxi cab medallions or permits in New York City that caused problems several years ago. So this was what I was talking to you guys about earlier, about these collective groups of like-minded individuals all pushing towards the same possible goal. However, there's the problem. There's the kink in the chain. The once stable taxi cab business was disrupted by the emergence of Uber and other ride-sharing services, leading to the closing of Melrose Credit Union and LOMTO Federal Credit Union in 2018, with member shares transferred to other credit unions. The collapse of the taxi medallion market placed an enormous strain on credit unions that serve the taxi industry and on medallion loan borrowers and their families. So this is literally like similar apples to oranges of what happened with Silicon Valley Bank. Silicon Valley Bank was primarily built on tech startups, emerging tech startups. Therefore, when there was panic, concern, risk, a liquidity crunch, crisis, bank runs initiated by the tech startup industry, that bank was extremely vulnerable. They put all their eggs in particularly one basket of that particular niche of customer, and that put them at risk. Similar to the credit union in this particular instance, when their primary account holder industry is threatened, forcing liquidity crisis, non-payment, late payment, bad debt, charge-offs, etc., loans not being repaid, then the credit union suffers, and therefore so does every other account in the credit union. Assuming these accounts are uninsured, amounts over the NCUA, FDIC, similar FDIC insurance limits. As you can see here, as the bank failed, the accounts were transferred to other credit unions. Everything was fine. Assuming everything was fine, probably there was some delay, probably there was some disruption, probably there was some panic and some confusion while the money was tied up. But the uninsured deposits, that home that was sold, for instance, and you put your money in the bank, the credit union, let me clarify that. You put your money in the credit union, that $300,000 you put in the credit union from just selling your home that you worked so hard to buy and maintain and then sell for a good profit to move on to your next endeavor, your next upgrade, your next purchase, your next investment, your retirement, your kid's college fund, or whatever it may be. That $300,000 that you put in your account that now exceeds the insurable limit is at risk. So therefore, if and when a credit union were to fail, that money would be lost. That money would be gone. That money is not insured. And odds are, based on what we have seen, heard, and are hearing from U.S. Treasury Secretary Janet Yellen, if you're not a part of a big corporate commercial Wall Street bank, then don't expect any special treatment like Silicon Valley Bank and having deposits, uninsured deposits, over these limits protected like they saw. Don't expect that to happen. So folks, short answer, are credit unions at risk? Are credit unions better than banks? Are credit unions safer than banks? I'll let you guys be the judge of that. Comment down below, let me know your thoughts. But at the end of the day, I think it still boils down to, in my opinion, diversity, security, and cash flow. I hope you guys found this information helpful, useful, educational. Please give this video a like, subscribe to the channel, share it with your friends, family, anybody that would be in need of hearing this information. If you guys got any comments, questions, concerns, drop them down below. Make sure you hit that like button. 100% free links in the description. And I'll see you guys on the next one. Take care. Bye.